Hello everyone and welcome back to the channel. This is the place where I break down the principles of value investing to help you invest in quality companies for the long term. For those who are new to the channel, my name is Anand and I am a software engineer turned quality value investor, managing my own portfolio for the last 7 years. Growing up in India, protecting capital was always the priority. As I committed myself to a journey of lifelong learning, studying giants like Buffett, Munger and Phil Fisher, I realized I could use my technology background to make value investing simpler. And that is why I built LVI, or Let's Value Invest, a platform built around these very principles of buying high quality, wide moat businesses. And I also created this channel to share the same learning with you all. Today we are diving into part 2 of our Q2 13F Filings series. In our previous video, we looked at concentrated managers managing between $1 and $4 billion. But today we are scaling up. We are looking at the absolute giants of the investing world. These are super investors who manage over $18 billion in assets, but still manage to run highly concentrated portfolios. Usually, when a fund gets this large, managers are forced to diversify into 50 or 100 or even 500 different stocks because they have too much cash. They basically become closet indexers. But the 3 managers we are covering today refuse to do that. They maintain extreme concentration, focusing their billions into just a few high conviction ideas. And if you watch until the end, we will look at Berkshire Hathaway, which is undergoing a historic leadership transition under CEO Greg Abel, while Warren Buffett continues to manage the main investment portfolio, and see how they are positioning their massive cash pile right now. Let us start with Duan Yongping, who manages H&H International Investment. Duan is a legendary figure in both business and investing. He is the entrepreneur who founded BBK Electronics, the parent company behind massive smartphone brands like Oppo and Vivo. In the investing world, he is often regarded as China's Warren Buffett. He is a close friend of Warren Buffett and famously bid $620,000 in 2006 to have lunch with him, bringing a young Colin Huang, the founder of PDD Holdings, along with him. Duan runs a private investment vehicle for his personal and family wealth, which means his official CAGR isn't publicly published, but he is widely known for compounding wealth at a staggering rate by focusing only on premium and high quality compounders. Looking at his card on LVI, his US disclosed portfolio value stands at a massive $19.1 billion. As we enter his portfolio, look at how he manages this scale. He holds only 18 stocks in total. His top 5 concentration is a massive 89.25%. Think about that. Almost 17 billion out of his $19 billion is concentrated in just 5 companies. His LVI portfolio score is a solid 3.45 out of 5, which rates as good. Now let us check his Key Insights tab to see the quality of what he owns. His MOAT score is a very good 4.36 out of 5, indicating he focuses heavily on businesses with massive competitive advantages. Then his business quality score is also a strong 3.84 out of 5. Now let us look at his holdings and his major moves in the second quarter of 2026. Duan had a quarterly activity rate of 17.59% with 1 new buy, 3 adds, 7 reduces and 2 sells. His absolute largest position is Apple, ticker AAPL, representing a massive 41% of his entire portfolio, worth over $7.8 billion. He trimmed this position slightly by 6.38% this quarter. But what is really interesting are his trimmings and complete exits. Duan aggressively cleaned up his technology and semiconductor exposure this quarter. He completely sold out of Taiwan Semiconductor, TSM, exiting his entire position. He also completely sold out of Crowdstrike, ticker CRWD, liquidating 100% of his shares. Additionally, he took significant profits off the table in other high-flying names. He reduced Nvidia by a massive 54%. Then he reduced Alphabet, GOOG, by 46.88%. He reduced United Health by over 33%. And finally, he reduced Microsoft by over 25%. So the question is, where did all this cash go? Duan rotated that cash into core quality anchors and deep value Chinese tech. First, he initiated a brand new position in Alibaba, ticker BABA, buying over 300,000 shares. This is highly notable because Duan has historically been a massive backer of Alibaba's arch rival Pinduoduo. Second, he added over 26% more shares to Pinduoduo holdings and bringing it to almost 10% of his portfolio. Third, he added 12.89% more shares to Disney, ticker DIS. And fourth, he added to Berkshire Hathaway Class B shares, which remains his second largest position at over 24%. This is a master class in capital allocation, taking profits in high-flying US tech stocks and rotating that cash into his stable Berkshire anchor and undervalued Chinese tech leaders. Now let us look at our second super investor today. Our second manager is Sir Chris Hohn, the founder of TCI Fund Management. Hohn is a concentrated activist investor who targets high-quality cash-generating monopolies with a strong focus on corporate governance. His track record is legendary. According to online databases, he has compounded capital at a staggering 18.6% CAGR over a 22-year period. In 2025 alone, his fund generated an estimated $18.9 billion in net gains for investors, which is reported to be the largest single-year gain in hedge fund history. So what makes Hohn truly special is how he scales concentration. On LVI, his US portfolio value is a massive $52.77 billion. Look at these metrics. Despite managing over $50 billion, he holds only 11 stocks in his entire portfolio. His top 5 concentration is a massive 84%. His LVI portfolio score is a solid 3.37 out of 5, which rates as good. Now let's take a look over the key insights tab. His MOAT score is a good 3.72 out of 5. His business quality score is 3.33 out of 5. Hohn's secret to compounding is his patience. He doesn't trade in and out of stocks. He finds monopolies and holds them for decades. Let's look at his two biggest examples of this, GE Aerospace and S&P Global. His largest holding is GE Aerospace, ticker GE, making up a massive 33.59% of his entire portfolio, worth $17.7 billion. If you look at the historical trend chart on screen, Hohn first bought GE in Q1 of 2023 when it was spun off as a pure play aerospace engine monopoly. He aggressively backed up the truck, buying shares up to Q1 of 2024 and has held it tightly ever since, riding the turnaround to massive profits. Now let's open the history model for S&P Global, ticker SPGI. Look at this chart. LVI has historical portfolio data going back to 2016, and it shows that Hohn has held S&P Global since 2017. He has held this position for nearly a decade, consistently adding to it on weakness, including a massive 19% add last quarter and another small add 0.33% this quarter. Today, it makes up roughly 10.87% of his portfolio. And this is the ultimate lesson in quality value investing. When you find a capital light monopoly like S&P Global or an aerospace monopoly like GE, you do not sell it just because it doubled. You hold it, let it run, and compound your capital over decades. But while Hohn is famous for holding, he made a shocking move this quarter. He completely exited Microsoft. If you look at his sales, Hohn sold 100% of his remaining 2.7 million Microsoft shares in Q2. This follows his massive move in Q1, where he slashed his position by 83.74%, dumping over $8 billion worth of Microsoft stock. For a concentrated long-term investor like Hohn, this is an extreme move. So why did he dump Microsoft? In his letter to investors, Hohn explained that he believes artificial intelligence or AI is a direct threat to Microsoft's competitive moat. Specifically, he fears that AI productivity tools could break Microsoft's lock on the office software market by fundamentally changing workflows. He also noted concerns about Azure's cloud infrastructure margins as AI scaling costs rise. Instead of holding Microsoft, Hohn rotated that tech exposure straight into Alphabet, ticker GOOG, adding 12.25% to his shares this quarter. Combined with his Class A shares, Alphabet now represents over 8.3% of TCI's portfolio. For us as investors, this is a fascinating perspective. While the crowd is chasing Microsoft as the AI winner, one of the best super investors in the world is dumping it because he thinks AI will destroy their moat. And our third manager is Berkshire Hathaway, which is undergoing one of the most historic transitions in corporate history. At the end of 2025, we all know Warren Buffett officially stepped down as CEO, remaining on as chairman in an advisory role. His successor, Greg Abel, has taken active control of both the operating businesses and the massive $300 billion investment portfolio. For years, Berkshire sat on a massive cash pile, but since Abel took over, he has shifted away from Buffett's quiet holding patterns and he is aggressively deploying cash, cutting legacy positions and putting billions to work. On LBI, the US stock portfolio value for Berkshire is close to $300 billion. Now look at these metrics. Even with this transition, the portfolio remains highly concentrated, holding only 29 stocks. The top 5 concentration is 68.65%. The LVI portfolio score is 3.31 out of 5, which rates as good. Now let us look at the key insights tab. The MOAT score is a good 3.81 out of 5 and the business quality score is 3.6 out of 5. Before we look at the new moves under Greg Abel, let us open the history model for Coke, ticker KO, to show the contrast with Buffett's legacy style. Look at this chart. Berkshire Hathaway holds exactly 400 million shares of Coke. And if you look at the transaction history list at the bottom, there is only one entry in our database. Every single quarter for years, the activity is simply hold. This was Warren Buffett's signature holding period is forever style. But Greg Abel is running a different playbook. Let us look at what he did in the second quarter of 2026. First, look at the massive addition to Alphabet, which is now Berkshire's third largest position overall. Between Class A shares and Class C shares, Alphabet makes up a massive 12.62% of Berkshire's entire portfolio. This quarter, Abel added 45.24% more GOOGL shares and added a massive 658% to GOOG shares. Now, Warren Buffett previously confirmed on CNBC that he was the one who initially bought Alphabet for the portfolio, showing his own willingness to learn and adapt to technology. But it is Greg Abel who is aggressively scaling this position into a major cornerstone of Berkshire's future. However, some of these new capital allocation moves do not fit my own quality value investing framework. And let me highlight two examples of not so quality moves. First, look at Macy's, ticker M. Berkshire added 141% to this position. However, it represents just 0.06% of their total portfolio, which is practically pocket change for Berkshire. Macy's is a brick and mortar retail business with declining revenues and heavy structural headwinds. This definitely does not fit my quality value criteria. And because it is such an insignificant position anyway, it is not something to write home about. Second, look at Delta Airlines, ticker DAL. Berkshire added 43.99% more shares. Buffett famously dumped all airline stocks during the COVID crash and historically spoke about how airlines are poor, capital-destroying businesses. And now, under Abel's education, Berkshire is buying back into Delta. As individual investors, this is why I use LBI. I do not blindly copy super investors, even Berkshire Hathaway. I look at their trades, but I filter them through my own strict criteria of business quality and durable moats. So those are the Q2 filings for the top 3 giant super investors managing over $18 billion. We saw 3 very different and fascinating strategies to manage massive scale. First, Duan Yongping clearing out of high-flying tech like Nvidia, TSMC and Crowdstrike to rotate capital into deep value Chinese giants like Alibaba and Pinduoduo. Second, Chris Hohn executing a shocking complete exit from Microsoft due to long-term AI threats to their moat, rotating that tech exposure straight into Alphabet. And third, the historic transition at Berkshire Hathaway, where Greg Abel is actively deploying cash and reshuffling the portfolio, buying into Alphabet while making some not so quality moves in airlines and retail. Even when the market gets volatile, these top managers are not panic selling. They are holding, rotating, and doubling down on quality compounders. If you want to track these 49 super investors yourself, check out the super investors feature on letsvalueinvest.com. It is a clean, ad-free way to find quality stock ideas and track what the best in the business are doing. Which of these three managers do you align with the most? Let me know in the comments below. Don't forget to like this video, subscribe to the channel, and I will see you in the next one. Happy investing.